Let's dive deeper into each of these bullish patterns in the stock market, along with their formation process, technical implications, and what they signal about market behavior. These patterns are often used by technical analysts to predict potential upward price movements. First up, the cup and handle pattern. The formation begins with the cup. The stock price gradually declines and then rises to form a U shape resembling a cup. This indicates the end of a downtrend, followed by a period of consolidation where prices stabilize. Next, we have the handle. After forming the cup, the price tends to pull back slightly, creating a short downtrend or sideways movement. This forms the handle part of the pattern. The breakout point occurs once the handle completes, and the price typically breaks out above the resistance level formed at the top of the cup, signaling a bullish trend continuation. In terms of implication, the pattern suggests that the stock has undergone a correction and is now ready to continue its upward trend. Regarding volume, there is typically a drop in volume during the handle formation and a spike when the breakout occurs, which adds confirmation to the bullish movement. For example, in Indian markets, you might observe this pattern in stocks like Reliance Industries or Infosys during long-term rallies. Moving on to their double bottom pattern. The formation involves the stock price hitting a specific support level twice with a moderate peak in between, forming a double U shape. The two bottoms represent strong support where the stock price fails to go lower. The intermediate peak between the two bottoms is considered a resistance level. The breakout point is when the price breaks above the resistance formed at the peak between the two bottoms, signaling a bullish reversal. In terms of implication, this pattern indicates that the selling pressure is exhausted and the market is ready to reverse from a downtrend to an uptrend. Regarding volume, during the second bottom, volume may decrease, and a spike often occurs during the breakout above resistance. For example, many Indian large-cap stocks like HDFC Bank or TCS exhibit this pattern during bullish market reversals. Lastly, we have the inverse head and shoulders pattern. The formation consists of three parts. First, the left shoulder involves a decline followed by a short rally. Next, the head is a deeper decline followed by another rally. Finally, the right shoulder is a smaller decline than the head, followed by a rally to the neckline. The neckline connects the highs of the left shoulder, head, and right shoulder and acts as the resistance. The breakout point is a breakout above the neckline, which signals a bullish reversal. This pattern is common in downtrends where a reversal is expected. In terms of implication, it signals that the downward momentum is weakening, and the stock is poised for a reversal into a bullish trend. Regarding volume, volume is critical during the breakout. Increasing volume during the breakout above the neckline strengthens the signal. For example, this pattern may appear during corrections in stocks like Tata Motors or Bajaj Finance before they reverse into a bullish trend. Alright, let's dive into the concept of the bullish flag. Formation. First, we have the flagpole. This is when the stock experiences a sharp rise in price, typically with high volume. It's like, a sudden surge that catches everyone's attention. Flag. After this strong upward movement, the price consolidates in a narrow range, forming a rectangular or slightly downward sloping flag. This phase represents a temporary pause before the trend resumes. It's kind of like the stock taking a breather before continuing its upward journey. Breakout point. A breakout above the upper boundary of the flag confirms the continuation of the bullish trend. So when you see this breakout, it's a strong signal that the price is likely to keep moving upwards. Implication. The bullish flag is a continuation pattern indicating that after a brief consolidation, the price is likely to continue moving upwards. It's a pretty reliable indicator for traders looking to capitalize on ongoing trends. Volume. Typically, you'll see a spike in volume during the flagpole and a smaller volume during the flag formation. A breakout above the flag is often accompanied by increasing volume. This volume behavior helps confirm the pattern's validity. Example, for instance, this pattern can be seen in stocks like Asian Paints or Maruti Suzuki during a strong rally. These examples make it clear how the bullish flag can play out in real market conditions. 5. Ascending triangle. The price makes higher lows while facing resistance at a specific price level. This forms an ascending triangle, with the rising trend line representing increasing demand and the horizontal resistance representing the supply zone. When the price breaks above the horizontal resistance line, it signals a bullish trend continuation. This pattern shows that buyers are increasingly willing to buy at higher prices, while sellers are holding at a fixed resistance level. A breakout indicates the sellers are exhausted and the buyers are likely to push the price higher. The volume usually declines during the formation of the triangle, with an increase during the breakout. Large-cap stocks like ICICI Bank or Kotak Mahindra Bank may form ascending triangles during bullish rallies. 6. Bullish engulfing candlestick pattern. A small bearish candle, often red, is followed by a larger bullish candle, usually green, that completely engulfs the previous one. This shows that after a brief period of selling, buying interest has increased sharply. The pattern is confirmed when the price closes higher than the high of the bullish engulfing candle. It signals a potential reversal of the current downtrend and indicates the beginning of an upward trend. High volume during the bullish engulfing candle strengthens the pattern signal. Bullish engulfing patterns can be seen in stocks during intraday or swing trading. Stocks like SBI or NTPC may show this pattern in a short-term downtrend before reversing upward. 7. Rising wedge in a downtrend. The price makes higher highs and higher lows, converging into a wedge shape. Even though the price is rising, the range between highs and lows narrows, signaling a potential reversal. In a downtrend, if the price breaks out of the wedge to the upside, it signals a bullish reversal. The rising wedge is often considered a bearish pattern, but when it forms in a downtrend and breaks to the upside, it can signal a bullish reversal. This pattern shows that the downward momentum is weakening. Declining volume during the wedge formation, followed by an increase in volume during the breakout, strengthens the bullish signal. You may see a rising wedge in stocks like Sun Pharma or Kepler during corrections that later break out upward. These bullish patterns help traders identify potential buying opportunities, signaling when a stock is likely to enter or continue in an uptrend. Do you have any specific stocks or sectors in mind where you'd like to see these patterns? Or are you looking for these patterns on charts?